Have you ever just, looked at a stock's price and thought, what is this thing really worth? Well, that's exactly what we're going to get into today. We're diving deep into something called fundamental analysis. It's basically the method investors use to look right past that flashy price tag and understand the real financial health of a company. All right, let's get into it.
So let's say you're faced with this choice. You've got 3 different companies, and as you can see, each one has a very different stock price. Your goal is pretty simple. Pick the best value. So, which one is it? Okay, so here are our options. Company A is trading at just $6 a share. Seems like a bargain, right? Then you've got Company B at $35, and Company C, well, it's way up there at $132. Now, that first instinct, it might be screaming to go for Company A. But as we're about to find out, the cheapest price isn't always the best value. And that, right there, brings us to the valuation puzzle. We need some way to see what's actually going on behind these prices, to understand the real company. So how in the world do we do that?
Well, the answer is fundamental analysis. Think of it like you're a financial detective. Seriously, it's the process of digging into a company's official reports, its books, to figure out its financial DNA and decide if the stock is actually a solid investment.
So to do this detective work, we need evidence. And that evidence comes from what you can think of as the company's financial report card. This whole thing is made up of 3 super important documents: the balance sheet, the income statement, and the cash flow statement. Our very first clue is the balance sheet. This document is like a snapshot in time. It gives you a really clear picture of a company's financial health by basically comparing what it owns to what it owes at one specific moment. So on one side of this balance sheet, you've got assets. Pretty straightforward, right? These are all the valuable things the company owns. We're talking cash in the bank, machinery, factories, buildings, you name it. And on the other side, you've got liabilities. This is everything that company owes to other people. Think of this as its tab, loans from banks or bills that need to be paid off. And the third piece of this puzzle is called shareholders' equity. Now, this is where it gets really interesting. This number represents the book value of the company. So if the company were to sell off everything it owned and pay back every single one of its debts, this is the amount of cash that would be left over for the shareholders. It's what the owners actually own free and clear. And this all leads to the one core principle of the balance sheet. It always, and I mean always, has to balance. The value of everything a company owns has to equal the value of what it owes plus what's left for the owners. It's like the fundamental equation of accounting, a law of financial physics. Okay, let's move on to our next clue and see how this all connects. While the balance sheet was a snapshot, the income statement is more like a movie. It shows you how profitable a company has been over a specific period of time, say a quarter or a full year. And the story this movie tells is actually pretty simple. You start with all the money the company brought in, that's its revenues. Then you subtract all the costs of running the business, those are the expenses. Whatever is left over is the famous bottom line, net income. You'll also hear it called earnings. But here's a little secret. A company's reported earnings don't always tell the whole story. This leads us to a classic saying you'll hear from investors all the time. Cash is king. Look, profit on paper is great, but having actual cold, hard cash is what lets a company survive and hopefully thrive. And that brings us to our final and totally crucial clue, the cash flow statement. This report tracks the actual cash moving in and out of a company. A key point here is that this statement is much harder to fudge than an income statement, so it gives you a much more realistic view of how the business is really doing. Okay, detective, we've gathered our clues from the 3 big financial statements. Now, we finally have the info we need to solve that puzzle we started with. We're going to use one of the most common, most powerful tools in fundamental analysis, the price-to-earnings ratio, or PE ratio for short. Now, the calculation is a simple 2-step process. I promise. First, you take that net income, or earnings, and you divide it by the total number of stock shares out there. That gives you something called earnings per share, or EPS. Then you just take the current stock price and divide it by that EPS. Boom, that's your PE ratio. All right, let's put this tool to work on our 3 companies. Company A, our $6 stock, has an EPS of 20 cents, which gives it a PE ratio of 30. Company B, at $35, has an EPS of $1.40 for a PE of 25. And Company C, our pricey one, at $132, has an EPS of $3.90, giving it a PE of 34. Whoa! Suddenly the picture is a whole lot clearer. See, by looking at the PE ratio, we can finally compare these companies on a level playing field. And what do we see? Company B, with the lowest PE of 25, might actually be the best value of the three, even though its price was stuck right there in the middle. We've officially looked beyond the price tag. Now, using the PE ratio is a fantastic first step, a huge one, really. But it's so important to remember that this is just the beginning of your analysis journey. There is always more to the story. So, the main thing to remember is that the PE ratio is just one tool in a big toolbox. There are tons of other ratios out there to measure a company's profitability and its overall financial strength. And those financial statements we talked about, they contain way more detail than we could cover here. The key is to just always keep learning more before you make any decisions. So, you've just added a really powerful new tool to your financial toolkit. You now know how to look past a stock sticker price and start analyzing its real, fundamental value. The only question left is, what story are you going to uncover next?